Welcome to the Deloitte Financial Reporting Updates, our webcast series for important issues and development related to accounting frameworks. Today, we present the new IFRS 9 hedging model. My name is Steve Aubin, and I am an advisory partner in the Calgary office. I will be your host for today's webcast, and I will be joined by others from the Kenyan practice. A couple of items before I tell you about the agenda and introduce our speakers. In the lower right-hand corner of the screen are the webcast links, which includes the link to the download and printout of today's slides, the links to the webcast assistance, the links to the Deloitte updates of upcoming sessions, as well as the links to the archive sessions. If you have a pop-up blocker on your computer, you will need to disengage it in order to download the slides or participate to our polling questions. For those of you who knows of a colleague who could not attend today's live event, they can simply register at any time for the event, the same way that you just did, and they will be able to view the archive webcast within 48 hours after this event. So please feel free to invite your colleagues to take advantage of this feature afterwards. In addition, although you're in a listening mode only, you can ask questions to our presenters during the session in the box at the bottom of the screen and click Submit. We will do our best to respond to your questions and comments during the presentation. We also have interactive polling question that will appear throughout the webcast on your screen. Again, we invite you to participate by simply answering these questions on your screen. A summary of the result will be provided on screen shortly afterwards. Now, let me introduce our speakers and discuss the agenda. First, you will hear from Kerry Danyluk, who will provide us with an overview of the new standard and some additional information on eligible hedging and hedged items under the standard. After Kerry, Kiran Khun-Khun will update us on the hedge effectiveness requirements of the new standard, as well as the accounting and disclosure consideration. She will finish with some important matter to consider on transition. And finally, we will conclude the session with a brief Q&A session. You can read the bios of our presenter and access the agenda and technical support in the navigation areas on your screen. Please keep in mind that it is a lot of material for a 90-minute webcast, so we will need to keep the discussion at a fairly high level. And as I mentioned earlier, if timing permits, we will conclude with a question and answer period. I'd like to remind our viewers that our comments on this webcast are our own views and don't constitute official interpretive accounting guidance from Deloitte. Indeed, as you know, before taking any actions on any of these issues, it's always a good idea to check with a qualified advisor. So before we kick it off, let's start with our first polling question. So we're going to ask everyone on the line to participate in the webcast in this webcast with our first polling question. And please note that your response will remain anonymous. So here's the first question. Are you considering early adopting IFRS 9 to take advantage of the new hedging standards? A, yes, B, probably not, and C, maybe. So while we're waiting for the results of the polling question, I'd like to remind you that today's webcast may be counted towards your continuing professional education. If you stay with us for the whole webcast, you can credit yourself with 1.5 hours towards your annual total. This applies to those in public practice and those working in the industry. We do not issue certificates for the webcast, but your email registration and confirmation can form part of your documentation in support of your attendance. So maybe let's look at the result of the first question. So we have about 5% of the people, 6% that are considering it, and 65 probably not. I would say that it's probably consistent with the discussion I had with a lot of companies out there over the last 6 months. Having said that, a lot of people are starting to consider the benefits and the advantage. We have to keep in mind that this is a fairly new standard that just came out in December, and it's really a thing that people are just starting to really understand the benefits. Now I'd like to welcome our first speaker for today's webcast, Kerry Danyluk. Kerry Danyluk is a partner in Deloitte's national office in Toronto. She specializes in a number of areas of IFRS, ASPE, and non-for-profit accounting. She has worked with entities in a number of sectors of IFRS implementation and complex accounting issues, including crown corporations, financial services, and public utilities. So, Kerry, I'll now turn it over to you.
Thanks, Steve. So before we get into the meat, I guess, of the hedging standard, I just wanted to give a little overview about IFRS 9. As you all know, I'm sure, IFRS 9 and the hedging installment that we're going to be talking about today is part of a larger project. And so all these pieces of IFRS 9 have been in development for a number of years, and we've got a little schematic on the slide here of, sort of all the various pieces and where we sit with them. So there's currently a number of parts of IFRS 9 that are available for early adoption, and today we're going to focus our comments on the general hedge accounting standard, which was just released late last year. And so this is the latest installment in the IFRS 9 story, I guess. So in terms of other pieces of the standard, we expect the new impairment standard to be finalized later this year, and macro hedging is still at a much earlier phase. It's still at sort of the discussion paper phase. So we currently expect that all the pieces of IFRS 9 will be mandatory for fiscal years starting on or after January 1st, 2018. If you've been following the project, you probably will remember that there was a thought at one point that parts of IFRS 9 would be mandatory as early as 2013. So we've really seen a fair bit of slippage, I guess, probably due just to the overall complexity and controversy of this project. So as I mentioned, there are various parts of IFRS 9 that are available for early adoption. And as we'll see on the next slide, there's a bit of complexity in the order to which these parts may be adopted. So the first piece of IFRS 9 to be released related to classification and measurement of financial assets. This part of the standard sets out the parameters for measuring financial assets at cost or fair value. There are currently some proposed changes to the standard out for comment right now, but we do have an existing version of this standard. We expect resolution of the exposure process later this year, so there may be some more changes to classification and measurement of financial assets to come. In the meantime, the current version of IFRS 9 on classification and measurement of financial assets is available now for early adoption, and this part of the standard could actually be adopted by itself. And in fact, a number of companies have adopted this standard. Not financial institutions, because the regulated ones have not been allowed to by their regulators, but we have seen companies in other industries who have early adopted parts of IFRS 9. So the next thing we got was guidance on classification and measurement of financial liabilities in 2010. This part of the standard can also be early adopted, but must be adopted with classification and measurement of financial assets. So if for some reason you wanted to adopt the financial liabilities part of the standard, you would also adopt the financial assets part that came out in 2009. In 2013, there was a more limited amendment that was released that deals with remeasurement gains and losses related to a company's own credit risk when financial liabilities are recorded at fair value through profit and loss. So this standard requires that gains and losses related to changes in own credit risk should be recorded in other comprehensive income and not profit and loss. So this part of the standard, just to make it even more confusing, can actually be adopted all by itself without any of the other pieces. So if you had something under IAS 39, a financial liability that you were classifying, carrying at fair value through profit and loss. So maybe it was a liability that had a complex embedded derivative or something like that, and you opted to mark it to fair value, then you could adopt this part of the standard that talks about what to do with gains and losses on the fair value remeasurement. So also in 2013, and this is the subject of what we're going to talk about today, we got the amendments related to hedge accounting. So if the hedge accounting standards are early adopted, then what you must do is adopt all the other pieces of IFRS 9 that came before. And so you need to adopt all of those at the same time. So if you do decide to adopt the hedge accounting rules, just recognize that that means that other things need to happen as well, such as making sure to classify your financial assets and liabilities under the new standard. So on the next slide, we just thought we should point out some of the things that have not changed from IAS 39. So applying hedge accounting remains a choice. And so first of all, maybe I'll just step back. So the main objective behind the new IFRS 9 changes on hedge accounting was to allow the accounting to more closely reflect risk management strategies. And also simplification was an objective as well. There was lots of concerns that hedge accounting was very complicated and didn't reflect the way people actually, or the way companies are actually hedging their risks. So really trying to deal with both of those things in the new standard, and I guess it remains to be seen how well they've achieved that as we get through our implementation of these new standards. But so let's just look at that. There's a number of things about IFRS 9 that are not changing. So they did want to make it simpler and more closely match up with risk management strategies, but they did leave some certain principles in place. So first of all, hedge accounting is still a choice. So what that means is if you are doing hedging, so economic hedging, I'll say, where you're not applying hedge accounting, you don't need to, and there's nothing in IFRS 9 would say that you would need to apply hedge accounting. You could continue with economic hedges and not seek hedge accounting. And in fact, really the only way to trigger your hedge accounting is to comply with all the pieces of IFRS 9, including designation and documentation, which is another feature of hedge accounting that we're quite familiar with from IAS 39, that the hedges must be designated at inception of the hedge relationship, and there's documentation requirements that need to be met. Also, there's no change under IFRS 9 in the kinds of hedges for accounting purposes. So if you're familiar with hedge accounting now, you'll know that there are, fair value hedges, cash flow hedges, hedges of a net investment in a foreign currency entity. So there's no change in the basic types of hedges, and really, a lot of similarities are pretty much the same in the mechanics of how those different hedges would be accounted for. So this next slide presents a good, more complete overview of the new hedge accounting standard and highlights some of the areas of difference that we'll go through in more detail through the presentation. As under IAS 39, just to get some of the terminology down, we will refer to hedging instruments, so what kinds of things can you use to hedge an exposure, as well as hedged items. So these are the exposures that are eligible for hedge accounting. So these two elements work together to form the hedging strategy for designation and documentation and accounting purposes. There have been some changes in what can be a hedging instrument, as well as changes in what are eligible hedged items. So we're going to go through these in a bit more detail shortly. And then Kiran is going to talk in more detail about the effectiveness assessment process. And so this is another area where hopefully the standard has become a little bit more user-friendly and somewhat more judgment-based than what we've seen in the past. And then as well, Kiran's going to touch on the disclosure requirements, which have been increased in the new standard. So first on to eligible hedging items. This first slide sort of presents, so I'm here, we're going to focus you in on what you can now consider to be hedging instruments under IFRS 9. And there's a couple of areas of difference that we're going to touch on. Under IAS 39, non-derivatives could be used as hedging instruments only related to hedging foreign currency risk. So, for example, you could use a U.S. dollar debt to hedge a net investment in a U.S. dollar foreign operation. So that's an example of using something that's not a derivative, being the debt, to hedge an exposure. but now this has been broadened out a bit more under IFRS 9, as we'll see. So let's look at an example. So an example, as the slide says, it's now possible to use non-derivatives in more cases to hedge exposures. And one of the examples that's given is a financial instrument measured at fair value through profit and loss could now be a hedging instrument. So what would be an example of that? So let's just say you are required, there's a company that has a highly probable forecast gold purchase. And so they know that they've got this exposure to the price of gold. And what could they use to hedge that? Well, under this new feature of IFRS 9, they could, in fact, go out and purchase units of a gold fund that holds physical gold. And those would be treated like, those would be a financial instrument because it's units of a fund. And those units, also under IFRS 9, would be carried at fair value through profit and loss. And so that could be a hedge. You could consider those units, that investment, as a hedge of the highly probable gold purchase. And then on the right-hand side of the slide, we're touching on the new guidance on using options and forwards as hedging instruments. It's a somewhat more complicated discussion, which we'll go through, but it does kind of open the door and make the accounting a little bit more friendly in that area. So let's move right on to that then on the next slide. So let's consider options for a moment. As under IAS 39, an option that you purchased would be recorded at fair value under IFRS 9. The fair value of an option consists of the intrinsic value and time value. So intrinsic value, of course, is just a little bit of a review here of some of the terminology, is the difference between the fair value of the underlying option and the strike price. So if the instrument is an option to buy stock, then the intrinsic value is the difference between the option exercise price and the fair value of the actual stock that you could buy. So then there's also time value, and time value includes volatility and can be somewhat volatile in your P&L. So under IAS 39, companies doing hedge accounting for options, so for strategies involving options, would often exclude the time value from the hedging relationship because that would give you better effectiveness in your hedge relationship. But it meant that that volatile time value element needed to be included in the profit and loss. So what have they done under IFRS 9? So for option-based hedging strategies, there will be the ability to exclude the time value from the hedging relationship. So we have that already. So what's different? In this case, so in the case of IFRS 9, a portion of the time value would be deferred in OCI. So how much time value gets deferred in OCI depends on how perfectly matched the terms of the option are to the hedged exposure. This is referred to in the standard as the aligned time value, which gets deferred in OCI. So if the terms of the option are not a perfect match, then some portion of the time value may have to be recorded in profit and loss. And this is what I'm calling the residual on my slide, so that falls to the P&L. The time value deferred in other comprehensive income would be recycled to profit and loss in a way that depends on whether the hedged exposure is transaction-based or time-based. So there's some different guidance depending on the kind of hedge that you're dealing with. So an example of a transaction-based exposure would be the purchase of an inventory, let's say like of a commodity or something, and you were hedging price risk. And time-based exposure may be seen in an interest rate hedging strategy. So what about forwards? Well, here they take a similar approach, and let's look at the value of a forward. So the value of a forward contract includes a forward element, which is the difference between the forward price and the spot price of the underlying. Under IFRS 9, it will now be possible to exclude the forward element from the hedging strategy, so similar to what we went through in options, and either record it immediately in P&L or defer it in OCI. So here we have a choice here to put it to the P&L or to the other comprehensive income, whereas in the option under the option discussion, it was only other comprehensive income if you decided to exclude the time value from the hedging relationship. So to the extent, so you defer it in OCI, and again, that's to the extent that the terms of the forward match the hedged exposure. So again, we have this idea of aligned forward element and being deferred in OCI and then recycled back into the profit and loss, and then the residual would go to P&L. So in IFRS 9, just to summarize, the option time value and the forward element are referred to as the cost of hedging. And under IAS 39, these elements would have been a potential source of ineffectiveness if included in the hedging strategy. And if you excluded them under IAS 39, then they would have fallen straight to P&L. So IFRS 9 is kind of giving a little bit of a better of both worlds in the sense that these costs can be excluded from the hedging strategy, probably increasing its effectiveness, but giving some ability to defer some of that volatility into other comprehensive income, so less volatility in the P&L. So let's move on. That's the discussion sort of the hedging instruments and some of the things that have changed on that front. And let's move on to eligible hedged items. So in this first slide, the top row is showing all the things that are eligible hedged items now under IAS 39. IFRS 9 is going to include all of these and adds the items that you see on the bottom row. So we'll talk about each of these in the coming slides. The non-qualifying items are listed at the bottom of the slide. These would also not have qualified under IAS 39. So for example, an entity cannot hedge any of its equity instruments, so it's issued equity. Also, hedge accounting cannot be achieved related to firm commitments to acquire a business. So if you have an upcoming business combination, let's say. Equity and method investments also cannot be hedged, or at least, you could economically hedge some of these things, but you would not be achieving hedge accounting. So let's look at an example. And this is probably one of the areas that is of interest to a number of people looking at whether or not they would early adopt IFRS 9. And this deals with risk components of non-financial items. So let's look at an example about what this could mean. So this sort of hedging strategy, hedging a risk component, starts with a consideration of whether there is a risk component that's separately identifiable and reliably measurable. So is there something in there that's a separate risk that you can identify and reliably measure and hedge? And so if you have that, then it's possible that you could develop a hedge accounting strategy that achieves a hedge of just that risk component. So that was not possible under IAS 39 in the past, except for in the case of just foreign currency hedging. So here now we're able to look at different elements of risk and possibly create hedging strategies that would achieve hedge accounting. So this example, the coffee example on the slide, is actually, we've developed it straight from one that appears in IFRS 9. So we have entity B, and they are buying Arabica coffee for their own use and for delivery. So they're using it, they need it for their business. In order to mitigate the risk of price changes, B enters into exchange-traded futures contracts for what's referred to as the benchmark quality of coffee. So that's the standard, futures contract that's trading on the futures exchange. It's not the Arabica that B purchases for its use, but a different quality of coffee for which the exchange-traded futures may be obtained. These contracts go out 15 months into the next harvest year. B has entered into coffee contracts to purchase the Arabica coffee for delivery from the current harvest. So they've secured basically their supply with these contracts. The contracts include a pricing formula which includes the price of the benchmark quality coffee. So you can see on the slide it says the purchase price, basically as specified in the contracts, includes an element that reflects, so at any point in time when they take delivery of their coffee, they're going to take part of the price would be related to the coffee benchmark quality price per the futures exchange, and then the quality premium, so the difference. So what's the difference between today's price for that benchmark quality coffee compared to the Arabica coffee, which is a different quality that we're actually buying, plus transportation charges because they need to actually get the coffee to where they need it. So we've got this pricing formula within the contracts. Now, beyond the current harvest, there are no contracts yet. So B doesn't really have any secured they don't have a contractually determined pricing formula yet for beyond the current harvest. But they do have highly probable future purchases for Arabica for the foreseeable future. That's part of their business. They need that coffee, and they know that that will continue. So the question that's asked on the slide is, to what extent B can hedge on a risk components basis? So let's look at the next slide, which outlines some of B's considerations. So first of all, for the purchases during the current harvest, B has Arabica supply contracts that include a pricing formula. In that formula, the price of the benchmark quality coffee is a separately identifiable risk component, and B considers it to be reliably measurable. So this is kind of their conclusion on this question. Therefore, they conclude that they can use the purchased coffee futures to hedge the risk component in the Arabica contracts, and that risk component is the price of benchmark quality coffee. So what about the period beyond the current harvest? And so remember, they've got no contracts right now, so they don't really know what those contracts for the purchases of Arabica, say, into next year are going to be. However, they do have their highly probable purchases, so that is potentially an exposure that would meet the condition of being a highly probable purchase, which would be the same kind of threshold that we would have seen under IS 39 in terms of probability. So since there's no contract, B needs to analyze the market structure and pricing to determine if the price of the benchmark quality coffee is separately identifiable and reliably measurable risk component. So based on their experience with the market and how their contracts for Arabica are eventually priced, B concludes that the price of the benchmark coffee is separately identifiable and reliably measurable, and so concludes that this is a risk component that can also be hedged with the coffee futures. So under IS 39, just to reiterate, the benchmark quality price could not have been hedged by itself, and this hedging strategy would have been very unlikely to have achieved hedge accounting, or this sort of hedging strategy where you're just hedging a component. So that's just a little summary of how we can open up, we can consider the door is opened up a little bit more in terms of hedging risk components. So in terms of what does this mean? Well, we now can think of hedge accounting being available for many more risk management strategies and non-financial risks potentially. So any kind of, as noted on the slide, any kind of risk management strategies that you're currently involved in using derivatives related to sort of, agricultural products, energy, precious metals, so basically commodities. So that is, as I said, that's one of the places where if people are thinking of early adopting IFRS 9, it's just, it's because one of the reasons maybe is because they have these kinds of purchases and hedging strategies, or they would like to do that sort of thing and get hedge accounting. So the next thing I'm going to talk about is a little bit different, but there are some changes in IFRS 9 as well. Now it may be possible to combine an exposure and a derivative to create an aggregated exposure for which hedge accounting may be achievable. So let's look at an example on the next slide. So consider entity A, which has the Canadian dollar as its functional currency. A enters into a Canadian dollar floating rate loan and then enters into a pay US dollar floating and receive Canadian dollar floating cross-currency interest rate swap. So this swap, this pair of instruments that we can see on the slide, the Canadian dollar floating rate loan and the US dollar interest rate swap, you would not achieve hedge accounting for that because we're not resolving, we're not offsetting a risk, we're actually creating one. In fact, economically, we've changed the Canadian dollar floating rate loan to be almost as if it's a US dollar exposure. So effectively, what we've done is created a US dollar floating rate exposure, as I said, and under IFRS 9, this exposure can be hedged by another derivative, and the hedging relationship would be eligible for hedge accounting. So you would not have been able to do this under IS 39. So this is another area to think whether, is there anything in your risk management strategies and so on where something like this would be attractive, since it's now possible under IFRS 9 to get hedge accounting in these kinds of situations. Okay, so the next thing I want to talk about is groups and net positions. This is a potentially complex area, but another one where we can see some more avenues opening up to apply hedge accounting. So the ability to, I think, have we gone ahead one too many slides maybe? Yes, thank you. Okay, so the ability to get hedge accounting would require that the items be managed together on a group or a net basis. Beyond that, there are other parameters impacted by whether or not it's a net position that you're looking at, or a group, or whether it relates to foreign currency exposure. So it does get into a fair bit of complexity and in the standard, and I just want to, and I guess the other thing to point out about reading the standard is there is the sort of the front part of the standard, IFRS 9 itself, and then it refers you oftentimes into Appendix B, which is where a lot of the guidance actually sits. So don't forget about that Appendix B when you're looking at it. That's where a lot of the examples, and in some cases sort of the meat and the whatever guidance is there, appears in Appendix B. So let's look at an example, just one of many possibilities as it comes to group and net positions. So consider a Canadian dollar functional currency entity with highly probable forecast consisting of purchases in 3 months' time of $300,000 US and sales of $500,000 US. So basically they've got, let's say, maybe a line of business where they're selling into the U.S. and they have some U.S. expenses as well. So one of the conditions for hedge accounting on a group basis is that the items be individually eligible for hedge accounting. So what does this mean? So in our case, we think about, because it's future forecasted transactions, we think about, are they highly probable? Would they individually meet the conditions for hedge accounting? Could I have hedged them on their own? And so here we're told in the facts of the case that these purchases and revenue are highly probable of occurring. So that condition would be met. And then we're also told that the exposure is managed on a net basis. So this is another requirement. And this is something that would have to be sort of observable and be a question of fact. Are you actually managing this exposure on a net basis? So if you can say yes to that and you've met the highly probable conditions, then potentially it's possible that you could, as this company has done, take a foreign currency forward for the net, being the $200,000 in 3 months' time, maturing in 3 months' time, and use that to hedge the net position. And so that's the question, is can we make that work? And on the next slide, we see that yes, the answer is yes. We're managing the risk on a fair value, or sorry, on a net basis. We're kind of given that in the facts of the case. So you have to think about what that would mean and how you would demonstrate that in your particular circumstances. But and as well, as I mentioned, individually, they are all highly probable transactions, and so they would potentially be eligible for hedging in the way described using this $200,000 US forward, which represents basically the net exposure. So when you do this, then the fair value of the changes of the entire population designated as hedged items is taken into account on a gross basis in assessing effectiveness. Fair value gains and losses on the hedging derivative, so the $200,000 forward, is recycled from equity when each of the US dollar sales and purchases hits income. So you'd have to, I guess, obviously find a reasonable, rational way to allocate those gains and losses as the hedge transactions occurred. So with that, Steve, I think I am.
Yeah, that's great. Thank you. Thank you very much, Kerry. So let's move on to our next polling question. So our second polling question for today's webcast is, which of the new features of IFRS 9 hedging are of most interest to you and your company for future hedge accounting? A, the ability to achieve hedge accounting for hedges of a risk component. B, changes related to accounting for the cost of hedging when hedging with options or futures. C, ability to have an aggregate exposure as a hedged item. and D, the ability to achieve hedge accounting for hedges of a group of net or net position. E, some of the or all of the above, and F, not sure yet. So, Kerry, while we're waiting for the audience to answer the question, I'd like to ask you one question. Currently, there's an ISB project that relates to hedging and dynamic risk management strategies. What is the difference between that project and the hedge accounting standard that we're talking about today?
So, Steve, yeah, that's a good question. That project is one that's also, people also call it sometimes the macro hedging project. That's what it has been called. I think it seems to have gotten a fancier name lately. And those are really the more complex hedging strategies, often used probably more so by financial institutions, where it's really what they have is a dynamic portfolio where the exposures are sort of constantly changing. And so the hedging strategy itself, like as the title suggests, needs to be much more dynamic. And so what that project is looking at is, to the extent to which or how could the hedge accounting principles apply in such situations. And so I think you can see that that's a more complicated series of questions and maybe a more specialized area of hedge accounting. So they didn't want to slow down, the process of getting some new hedge accounting guidance out for the more general hedging strategies. And so what they did was a couple of years ago, they decoupled these projects and said, okay, we're going to go with the more simple general hedge accounting project, and we'll going to take more time on the macro hedging, and that's where they're at the discussion paper stage right now. So that's even actually before we even have an exposure draft. They're still kind of in their fact-finding and developing their positions mode. So that's basically a little bit of an overview of the difference between those two projects.
So it sounds like that project really would align hedge accounting a little bit more with the risk management policy of a lot of companies.
Right. Certainly those doing, I guess that's the hope, but certainly, and especially for those like financial institutions with those very complex strategies.
Good. So let's go back to our polling question. Let's see the results here. Okay, so I think some of, or all of the above, 35%, and not sure yet, 40%. I'm not surprised with some or all of the above, because from my experience in working with some companies adopting the new standard, and I bear in mind that I have focused much more with a company that deals with commodity, but the ability to hedge here risk components has been a huge factor on those companies early adopting, especially in the commodity world. And the other thing as well that was a huge benefit for some of the company was really the ability to defer the time value of the options in OCI. And we saw that very relevant to the oil and gas industry, given that in this industry, a lot of companies will use costless collar to go and hedge their exposure. So that would be consistent a bit with the results here. So now I'd like to welcome our next speaker, Kiran Khun-Khun. Kiran Khun-Khun is a partner in the Accounting Advisory Group in Toronto with over 15 years of experience with Deloitte. As the Accounting Advisory Group is part of a national and worldwide practice, Kiran is involved in complex accounting across various number of topics with a specialty in the area of financial instruments, hedging, and valuation. So Kiran, I'll welcome and I'll turn it over to you.
Thank you, Steve. What I'll be doing today, I'm just going to be picking up from Kerry and spending the next session going through hedge effectiveness. That's been an area of significant change in IFRS 9, going through the accounting disclosure along with transition impacts and questions to think about in determining whether early adoption makes sense to you, why, who's doing it, what are folks thinking about. So let's kick it off with hedge effectiveness. So you'll see on your screen, you have it right there. You've got the requirements that must be met to demonstrate hedge effectiveness. So from the left to the right, there must be an economic relationship between the hedged item and the hedging item, so the risk you're trying to manage and the derivative product that you're using to manage that risk. The effective credit risk cannot dominate the relationship, and the hedge ratio must be established. So 3 parameters. I will talk to each in turn, and because hedge ratio is the last item to the right in your screen, because hedge ratio is the newer concept in this hedge effectiveness test, I will be spending a couple of slides diving deeper into what that means. So from an economic relationship perspective, that means that generally the fair values of the item or the risk that you're trying to manage must move in the opposite direction as the derivative that you've taken out to manage that risk. So what that's done, as Kerry mentioned, is it's opened the doors to be able to hedge variables that are economically related to each other. So from a commodity perspective, you may have a Brent-based derivative from a oil pricing perspective that is being used to economically manage the price risk of a WTI, which is the different indices for oil, a WTI, forecasted sale, for example. Under old GAAP, it was very difficult to be able to establish hedge accounting in that scenario. Under this test, all that would need to be done is that one would need to establish that an economic relationship does exist between the WTI price risk and the Brent price risk. Credit risk, this one is sort of a concept tossed in just to make sure that as the fair values move between the item you're trying to manage the risk of and the related derivative product, that there are no other movements that are frustrating the relationship. So from a derivative valuation perspective, there is a piece of the derivative fair value that we term in accounting the credit valuation adjustment. That credit valuation adjustment, or that reflection of the credit quality of the counterparty to the contract, cannot frustrate, significantly impact the movement in fair value of the derivative such that it stops from doing a good job at providing that economic offset with the risk it's been identified to or transacted to hedge. Hedge ratio, this concept essentially says, you can only put into the hedge relationship the quantity of the derivative that you've transacted from a risk management perspective to offset the risk exposure you'd like to hedge. So it's very important. This is a new concept, and there is documentation required to establish what the hedge ratio is for each hedge relationship. And what it does, it guides on a go-forward basis what to do if there is an imbalance in the hedge relationship. And I'll get back to that and talk to that in a bit more detail. The main benefit, or the biggest benefit from this revised hedge effectiveness requirements, you've got the 3 pillars laid across your screen, is if I focus on the economic relationship, because we're establishing an economic relationship between the item we're hedging and the derivative we've transacted, there is no mandatory 80 to 125 rule. So you will see that there's nothing on this slide across the top part of the screen that says that the hedge relationship quantitatively needs to be between the traditional 80 to 125 range. So that has been dropped. The test can be qualitative or quantitative. The standard does not prescribe what type of test to do in either scenario. And the additional benefit is that retrospective testing has been dropped as well. So we end up having a day one test like we've always done at inception of each new hedge relationship performed. So that's our day one inception test. It's our look forward effectiveness assessment. And then on an ongoing minimum quarterly basis, we're doing a continual look for the prospective test. So that's a new piece of testing requirement within IFRS 9. One of the key takeaways that I've been seeing from clients early adopting is keeping in mind that even though a test may be qualitative, even though it may not be as robust quantitatively as it would have been under IAS 39 because of that 80 to 125 rule, the amount of noise in a relationship is still required to be measured. So that ineffectiveness still is required to be quantified because we are still doing financial reporting. We still need to identify for cash flow hedges how much is able to go into OCI, for example. On to the next slide, I do want to spend some of our discussion just talking about what factors to consider when we're deciding whether a qualitative or a quantitative test makes sense for a hedge accounting relationship. I've had a lot of people say, Kiran, the 80 to 125 rule is gone. We can do qualitative testing. This is great. We can simplify our math. We no longer have to do regressions. Does that make sense? Do you agree? And the spectrum of looking or helping assist determining whether a qualitative or quantitative test makes sense, I think really gets back into being able to support whether an economic relationship exists. And to that point, you have to really be able to be comfortable that as the derivative changes in fair value, that it will economically offset the change in risk that you're trying to hedge. Now, this can be met qualitatively. For example, if your critical terms, meaning the key terms in your derivative that influence its cash flows and then therefore influence its fair value, if those key terms and conditions are perfectly, without exception, mirrored in the risk that's trying to be hedged. So, for example, if you've got, a floating rate liability, Canadian dollars, it's based on 3-month banker's acceptance. It matures December 31st, let's say 2014, and we go out and trade a derivative today that is receive floats, 3 months banker's acceptance, pay fixed. It also matures on December 31st, 2014. Its payment dates, its reset dates match perfectly with the debt. There is the opportunity to say, qualitatively I can get there. I can demonstrate qualitatively that there is an economic offset between my derivative and my debt because the terms that influence fair value changes match perfectly. Once you move away from that scenario in terms of, perhaps there's a mismatch, perhaps the derivative is not 3 months banker's acceptance, received 3 months banker's acceptance. Maybe it's received, 1 month banker's acceptance, for example. Perhaps the payment dates are not aligned. Once you move away from the critical terms being perfectly aligned, there's an increased level of uncertainty in being able to say that there's an economic relationship between the derivative and the hedged item without having to crunch some numbers. So this slide is illustrating as you move from the critical terms match exactly and all the way up to significant mismatches, you are starting to get into a quantitative world, and then how much a quantitative world is necessary really depends on how different the key terms are between the derivative and the hedged item. So let's talk a bit more. We've talked about effectiveness. Let's talk more about that hedge ratio concept. This one's actually quite interesting. It was really introduced to simplify the world of discontinuing hedge relationships. So under IAS 39, when we have a situation where, the hedged item changes, the derivative notional changes, hedge effectiveness falls out of the 80 to 125 parameter, those three scenarios call for an automatic de-designation under IAS 39. And one of the criticisms of IAS 39 is and was that when you have these de-designations, it creates a complex accounting environment simply because you need to be able to track or keep track of all the discrete hedge accounting adjustments you've made and be able to pull that into P&L when appropriate throughout the life or the original life of the hedge relationships. So because of that cumbersome type of accounting in the folks saying that they want to simplify hedge accounting, this concept of hedge ratios was identified. And what hedge ratios are meant to illustrate or nail down is based on the risk management objective of a particular hedge relationship, once a derivative notional has been put into a relationship and once the corresponding risk has been put into the relationship, as long as that economic relationship exists in the beginning, if that economic relationship is altered throughout the life of the hedge relationship, there is the opportunity to rebalance or readjust how much of the derivative is contained in the relationship and or how much of the item that's being hedged is contained in the relationship. So this concept does not apply to scenarios where, for example, I forecasted I would have revenues of $1 million on December 15th, 2014, and I end up having revenues of 0 on December 31st, 2014, or I end up having 50% of the revenues I thought I would have on December 31st, 2014. In those scenarios, you would get into, the de-designation world because the hedge item doesn't exist. The rebalancing accommodation or concept would not help those scenarios because there has been no change in an economic price relationship between the derivative and the hedge exposure. An example the standard does talk about to illustrate this concept is if, for example, you had a foreign currency exposure and currency A, and you took out a derivative that was pegged to A via a foreign currency B, so you've got an environment where the exchange rate is pegged to different currencies. Once you've established that economic relationship at the beginning, you've documented it. If something was to happen during the hedge relationship, maybe the overseeing committee who sets the time bands, the pegged rate, changed or adjusted that pegged relationship. In those situations, because an economic relationship between two variables, foreign currency A and B, that was established at inception has now changed, this is a way to adjust the amount of the foreign currency A and foreign currency B in the relationship without triggering an automatic de-designation. So because you can rebalance in those scenarios, you are allowed to continue hedge accounting. You just need to be able to update your hedge documentation and then continue forward. But like I mentioned, it's not meant to accommodate or to facilitate the continuation of hedge relationships when there's been a change in the fair values of the derivative and the hedged item that have nothing to do with an economic relationship. One example of that would be credit valuation adjustments. So just to illustrate the concept of rebalancing or hedge ratios first, actually, before we get into rebalancing, an illustration on rebalancing, what I wanted to do is identify or walk through 3 scenarios that can occur that we do see in practice, walk through each of those 3 scenarios, and then talk through what the hedge ratio would be in each of those scenarios. Example 1, so we've got example 1 where we've got an entity producing fridges, and they do need to purchase copper in order to facilitate the production of those fridges. They forecasted that they will purchase 1,000 tons of copper in 3 months. To do so, based on the risk management objective, they're going to be entering into 800 tons of copper forecasted forward purchases via a forward contract, so that would be a derivative because they would cash settle on that forward contract. So the risk management objective is to manage the price risk of 80% of their forecasted copper purchases. Based on this relationship, entity X would establish that its hedge ratio is 800 tons for their derivative, hedging 80% of the 1,000 forecasted copper purchases. So that would be established at day 1 in the hedge documentation, and that would be the hedge ratio for this relationship. Example 2, we've got entity Y. They've got forecasted foreign currency revenues, USD, and they're projecting it's going to be $97 million. Based on their risk management objectives and the market sizing, the lots that can be purchased for forward contracts, they can only purchase at one, in this example, 100 million USD forward contract. So because their risk management objective is to purchase 100 million, they also have a constraint to purchase. They're only able to purchase 100 million based on the lot sizes. They are, from a hedge ratio perspective, putting in the $100 million of USD forward contract in full in a hedge relationship for the $97 million USD forecasted FX revenues. Example 3 is a common one, and I did want to highlight this one. So in this example, we've got an entity that has fixed rate loans. It's got a nominal principal amount of 200 million Canadian. They'd like to be able to manage the risk of their interest rate risk, fair value hedge of their fixed rate loan by entering into, from a risk management perspective, a hedge of 100 million via a derivative, an interest rate swap. So they've established that they'd like to hedge 50% of their interest rate risk exposure arising from their 200 million Canadian debt. They run some numbers, they crunch some numbers. Perhaps the credit valuation adjustment on the derivative is a bit high. There could be some differences between, for example, the terms of the derivative or the terms of the debt. And what they'd like to do to minimize the differences and better the hedge effectiveness results, they'd like to put in the 100 million interest rate swap into a hedge with 105 million CAD exposure on their debt side. IFRS 9 would only permit the designation of 100 million of the fixed rate loans, even though entity Z would like to put 105 of the CAD loan into the relationship. They're prevented from doing so because from a risk management perspective, the derivative was only transacted to hedge 50% of the risk exposure. So this is one hedge ratio example where I do tend to see some adjustments as we're going through into IFRS 9. Once we've established that rebalancing makes sense, the next step is the how. How do we do the balancing act, if you will? So this slide just illustrates for us that once we've noticed or identified that the hedge ratio needs adjustment, which, in my mind is the bigger interpretive area, when is a hedge ratio adjustment appropriate? The how of how it's done is quite simple. You simply would either adjust the quantum of the hedged item or the quantum of the hedging instrument in the relationship, depending on where the economic relationship has moved and what's necessary to reset the relationship. And once that's done, it's documented, and any P&L impacts from that rebalancing is taken immediately to the income statement. So moving on to the next slide, into the de-designation discontinuation world, just to round out the hedge ratio discussion. So again, if hedge ratio rebalancing is appropriate for a hedge relationship, it does not trigger a de-designation discontinuation. What does trigger a discontinuation de-designation is on your screen. It's the middle green of the three middle green items. The middle one is consistent to IAS 39, so if the derivative has been terminated, sold, the relationship stops, no longer continues. The top criteria and the bottom criteria are new under IFRS 9, and it's really getting back into the purpose for transacting the derivative. So has a risk management objective changed? If it has not changed, then you will continue hedge accounting for the relationship. If the risk management objective has changed for that particular hedge accounting relationship, then it actually triggers an automatic de-designation, even if you have, perfect hedge effectiveness test results. If there's been a change in the risk management objective, there is no spectrum of how much of a change is, how much of a change will trigger a de-designation. Any change in the objective will trigger a de-designation for that hedge relationship. Also, the bottom condition, if there is no longer an economic relationship or if the credit risk dominates, so you'll notice that these are the two conditions to establish hedge effectiveness. If either of these two items no longer are met, no longer an economic relationship, credit risk now dominates, then there's an automatic discontinuation. You'll see again that hedge ratio is not on here, so if there's been a change to the hedge ratio, hedge relationship will continue. There is not an automatic de-designation. The one item I do want to make particular note of, which some folks were not happy with, is you are not allowed to voluntarily stop hedge accounting under IFRS 9. There's no ability to do that. We can under IAS 39. That ability was removed under IFRS 9, simply again going back to the observations that the accounting for discontinuation of hedge relationships was too cumbersome under IAS 39. So we've summed up to this point effectiveness testing, the hedge ratio, determining whether we can, what decisions will help us, our thought process will help guide whether we do a qualitative or quantitative test. I want to spend the next part of the session talking through accounting disclosure and transition. So the good news is that the accounting, fair value hedge accounting, cash flow hedge accounting, the mechanics of the accounting are untouched, not altered by IFRS 9. Kerry did talk about the accounting for time value of options and the time value associated with forwards. That's the area that has changed from a hedge accounting perspective, but the traditional concepts around the use of OCI for cash flow hedges and doing an adjustment to the hedged item and fair value hedges has not changed. That remains consistent. From a disclosure perspective, significant increased disclosure. It's been, in my mind, it's slotted into three different buckets. The why are you doing hedge accounting? That's a risk management strategy. The what is it all about? What's the effect on cash flows? And the how is it impacting our financial statements? You'll see the standard actually does have a template that they've identified on how to organize the information. From a tracking perspective, I think this will be the area where folks will just need to step back because all the information actually is meant to be recorded in a note or cross-referencing amongst notes, just to provide or ease the ability for readers to understand the hedge accounting activities of an entity. I think there will be time just spent sitting back and reflecting on where all the information is contained in the notes of financial statements and just organizing the information in a clearer way to facilitate compliance with the IFRS 9 requirements. From an illustrated perspective, as I mentioned, IFRS 9 has some examples. They've provided how one must present the information for the derivatives, and it's a tabular format, and it answers the question of how have you reflected your derivative hedging activity in your financial statements. So there's the organization by type of hedge, cash flow, fair value, type of derivative, terms of the derivatives, what line items in the financial statements are these items impacting. Similarly, on the other side, the hedged item side, there is similar tabular disclosure, where we'll have identified by hedge relationship, so cash flow and or fair value, for example, the types of items in hedged in each bucket, what the carrying amounts are, the balance sheet adjustments, so that a reader can easily identify the numerical amount of the hedged items, what it relates to, and where to find it in the financial statements as well. From a transition perspective, IFRS 9 is a prospective standard, and this slide just captures the impacts of existing hedge strategies on adoption. So where we have a hedge relationship, the first bucket on the top of your screen, which was compliant with IAS 39, it continues to sit well within IFRS 9. IFRS 9 would permit the continuation of that hedge relationship. We would just reset the hedge ratio as applicable, and that hedge ratio would establish the starting point for the continuous movement from IAS 39 to IFRS 9 from a hedging perspective. So if you had IFRS 9 compliant hedge documentation already in place, there is the opportunity to have that seamless movement through. For relationships where IAS 39, the qualifying criteria was not met under IAS 39, so hedge accounting was not pursued. At IFRS 9, as long as the qualifying criteria for hedge accounting is met, you're moving forward from a prospective scenario. And in rarer cases, you may have situations where you've had an established hedge relationship under IFRS 39, does not comply, the qualifying criteria are not met under IFRS 9, and then there would be a mandatory discontinuation of that hedge relationship. This category is expected to be rare. So prospective accounting, there is a concept of retrospective adjustments, and it's isolated. It only applies to the two elements that Kerry had talked about in her presentation, and that's the time value of the options and forward points as it relates to forward contracts, for example. For time value of options, this is a mandatory retrospective application. So if you have hedge relationships, you use options, you excluded the time value from those relationships under IFRS 39, then the accounting to use OCI for the time value is pushed back based on the population existing at the earliest opening balance sheet date. And for the forward contracts, that retroactive pushback is optional. And if it is selected, it's done for all hedging relationships for which the forward points were excluded. So aside from the numbers, the numerical transition, some things to think about on transitioning from IFRS 39 to IFRS 9. So planning for early adoption. If you are in a scenario where you'd like to make sure that you achieve hedge accounting for your current strategies when you move into IFRS 9, so you want to be in that first column, the seamless move through from a hedge accounting perspective, it's a good idea now to revisit your hedge relationships, make sure that they comply with IFRS 9. If they don't, is there an opportunity to be IFRS 9 compliant, plan for having documentation that would suit both standards if that's possible. So that's our strategy for dual designations, having designations that are IFRS 39 compliant and IFRS 9 compliant currently as we move into IFRS 9. Demonstrating the economic relationship. So I think this will be really important where we are in the world of hedging risk components. So being able to demonstrate that an economic relationship does exist between two different variables. Rebalancing, is it applicable to every situation? That's going to be the area where I think will apply to some scenarios and not to others, and likely in scenarios where you've had to spend a lot of time thinking about the economic relationship. And again, managing the interpretive areas of IFRS 9, there is a lot of opportunity in IFRS 9 for increased hedging, which will lead to questions as to how should the relationship be established, what should the testing look like, and how do I calculate my hypothetical derivatives, for example. We've talked at this point about the numbers. I do just want to highlight this from a documentation requirement standard. IFRS 9 is still a documentation standard. So the documentation, the words that you're used to still exist under IFRS 9. What I've done on this slide is just highlight for you what's gone away and what's come on, and that's in light blue. And you'll see that there's not much that's gone away. I've only striked out one little item in your third bucket, and that relates to performing and documenting the retroactive effectiveness assessment. What's come on are the two items I've added in blue in your middle section there, and that is documenting the hedge ratio once it's been determined, and also analyzing the sources of any hedge ineffectiveness, which is required under this standard. So knowing that the adoption for fiscal year starting Jan 1, 2018 will occur for sure when we do get there from a mandatory adoption perspective, just some helpful hints to think about as you're thinking through whether early adoption does make sense for you. As I mentioned, there are more opportunities for hedging under IFRS 9. Kerry talked to the fact that IFRS 9, if IFRS 9 hedging is early adopted, it must be adopted in conjunction with the other pieces of the finalized standard of IFRS 9. So that's something to keep in mind. There is significant documentation from an IFRS 9 perspective, but again, if you've got strategies that are leverageable from what you have now, that's something that can be managed. Interpretive issues, whenever you've got, whenever you're adopting any standard first, there's always the opportunity to have interpretive issues and be the one that's dealing with those issues versus your peers who may be adopting the standard at the mandatory adoption date. Going forward to the next slide, this is just a slide we put together that's taking the lessons that we've been learning as we've been moving with clients through their early adoption as to, from a strategy perspective and an organization perspective, what to think about in terms of next steps if you are thinking about early adopting. Risk management documentation, understanding what exists, what strategies are driving transacting hedge relationships and derivatives is key. That is the basis of IFRS 9, and there is a requirement to be able to link and document the linkage between established hedge accounting relationships and the related risk management objectives. The dialogue between Treasury and accounting is extremely important in this regard, and that just flows right through the identification of the risk, financial setup of the type of quantitative effectiveness assessment that must be completed, any tag-on effects from a control process, and communicating new hedging relationships, the results of those new hedging relationships to management as well. So from an early adoption perspective, some other ahas we've noticed just from a driving force perspective, what's driven some folks to move towards early adoption. The standard came out in November, and these are the areas that we've seen people who have early adopted adopt for these reasons. So currently the hedge relationships from a risk management objective perspective under IAS 39 are not achievable for hedge accounting, but are so for IFRS 9. Kerry talked about risk component hedging. That's one of the main areas where people have seen IFRS 9 to be a benefit. We've got a significant amount of commodity hedging, so we have an opportunity now to use the economic relationship guidance in IFRS 9 to establish those derivatives and hedged items into relationships strictly by the guidance on economic relationships for the hedge effectiveness assessments. Managing FX risk on a net or group basis, and as Steve had mentioned, when we've got clients who have options, costless collars, forwards, etc., they've seen that this standard is also beneficial from an early adoption perspective.
Well, perfect, Kiran. Well, thank you very much. I think we can probably move on to the final polling question and then maybe come back with a few questions for you. But let's go with the polling question number 3. Thinking back of our first question about early adoption, have you changed your mind? So since the beginning of the session here, have you changed your mind? A, yes. B, no. C, you were planning to early adopt and still thinking you will. And D, I thought we might be early adopting, but we are probably changing our mind. And E, I'm not sure, I still need more information. So while the audience here is responding to the question, Kiran, I'd like to bring a question from the audience here for you. Question goes as follows. We apply cash flow hedging using the hypothetical derivative method. Does that concept still exist under IFRS 9?
Yes, and that's actually a really good question. And it's funny. I had a client who was we're having a conversation talking about using the qualitative assessment approach, and it made sense for their particular strategy. They were in line with the example I had where everything matched, but they still, you still need to use a hypothetical derivative method to be able to quantify, to do your math for your accounting. So you could run into a scenario where perhaps you're not crunching the numbers from a quantitative effectiveness assessment perspective any longer, but that does not mean that we still don't need to quantify what that hypothetical derivative looks like for accounting, because there is still a requirement to measure ineffectiveness. Okay,
that's good. So let's move on to the result here. Perfect. So I'm just looking back at the answers. At the beginning of the session, 6% said that they would go for it. 65% said that they would not go for it. So it went down by almost 18 points here. And then we had an earlier question about 29 of maybe. So it looks like the additional information perhaps that we provided here gives some good food for thought. So that's good. And then I guess what I want to do right now is that we'll finish the formal portion of the webcast before we begin the question and answer period. We would appreciate your feedback and kindly ask that you complete our survey. You should expect to see a pop-up survey appearing on your screen shortly, and this survey assists in our development of future webcasts. We take these surveys very seriously, so please continue to send us your suggestions, and feel free to also let us know if we're doing something well. We want to make sure we keep it up. If we don't have all the time to address your question today, especially if the question is regarding specific facts, patterns of your organization, I would recommend that you discuss these questions with your Deloitte partner or Deloitte contact so that they can help you resolving the questions or concern you may have. So as I said, this finished the formal portion. I'd like to go through the Q&A, and then I'm just going to pull out here the first question that came, I should say the second question that came from the audience. And so the question goes as follow, and Kerry, I think you would be, that would be probably a question for you. Did you mention that adopting IFRS 9 is optional? Meaning that the choice to remain under IAS 39 is possible, but disclosures are mandatory regardless as of January 1st, 2019?
That's a good question, Steve, and it's complicated, so it's worth going back over that and clarifying. So for now, we have all the pieces of IFRS 9, some of which, can be early adopted by themselves, as I went through in that one slide. But if you wanted to adopt the IFRS 9 hedge accounting now, you could, and you would have to adopt the whole, all the standard that exists. Now, when I say adopt it now, I guess that's important as well, too, because you have to remember, because since it's a documentation standard, you can't start hedge accounting before you have the documentation. So you can't start hedge accounting until you've, decided and put your strategies in place and documented them. So it is, in that sense, it's somewhat perspective. But so we could adopt it now. And if you do not adopt it now, then you would stay in IAS 39 for hedge accounting. But by 2018, or whenever it is that the standard finally becomes mandatory, you would have to adopt all of it. So the new hedge accounting standard, all the related disclosures, all the rest of IFRS 9. I guess the other point to make, though, is you do not have to ever actually do hedge accounting. You can do hedging, economic hedging, without doing hedge accounting. So I don't know if that's part of what the questioner was asking. When I did say that hedge accounting was optional, is that you never have to do hedge accounting, and that will still be true under IFRS 9. But the whole standard must be adopted by January 1st, 2018.
Okay. Good. Thanks for the clarification. Let's go, Kerry. Let's keep with you here, and let's go to another question. Can you confirm if the ineffective portion of the hedge still goes directly through the income statement only under IFRS 9?
Yes, Steve. So that's true, and essentially it goes back to the idea that a lot of the mechanics of actual hedge accounting have not changed. And so if there is ineffectiveness, and Kiran talked about, she emphasized that even though we're going to a more qualitative, perhaps, way of being able to assess whether or not your hedge is effective, you still need to measure, if it's not perfectly effective, then there will be ineffectiveness. And so we need to know how much that is, and especially for cash flow hedges, because that'll dictate how much of the gains or losses on the hedging instrument go to other comprehensive income. So effectively, the ineffective part of the hedge will still fall to P&L. Generally speaking, I guess the only exception would be if you are hedging an equity investment, so an investment in a share, which under another part of IFRS 9, you might have said, I'm going to record gains and losses on that equity investment through OCI. Then in that case, maybe it's a different answer, but generally speaking, for most hedges, ineffectiveness would go to P&L.
Okay, perfect. Kiran, maybe one question for you here. In the absence of credit risk being a factor in the determination of hedge, do we still have to account for credit value adjustments?
Yes, the answer is yes, and that hasn't gone away. So IFRS 9 does not touch the requirement that derivatives need to appropriately capture all of its credit quality, so adjustments to the swap curve. So that will continue untouched in IFRS 9.
Okay. Well, I have another question on ineffectiveness here. It goes back to slide number 28. In the example 1 of slide 28, why is 80% designated as the hedged item instead of 800 tons? And I don't know if the operator here can turn back to slide 28. That might be helpful.
So I recall that illustration. So the hedge documentation, whenever we have a forecasted transaction and it's sort of first dollars base, we always say that it's the first X percent from a documentation perspective, just in case the required notionals change. So, you could have, instead of 1,000 tons coming in the door, you could have more than 1,000 tons. So the documentation, should say the first 80% of 1,000. So it's a, either way, the documentation could say the first 800 of the projected cash flows or the first 80% of a define. So either way, as long as it's clear in the documentation, then it would establish what one should expect. And that's really the guiding principle for identifying your hedged items, because you need to be able to specifically identify that the hedged item has occurred in the quantity that you said that it would.
Okay. Well, perhaps let's go back with Kerry here for one question. Kerry, does this standard mandate how to determine if the risk component is separately identifiable and reliably measurable? If not, is there a suggested approach?
Okay, Steve, thanks. So the standard does not mandate that. In the example that we looked at, the coffee example, it was clear in one part of the example, it was clear in the contract. So that's a really good way to observe that it's separately identifiable, and then measurement is maybe another issue. If you don't have that and you do not have it specified in your contract like that, which I guess often we will not, then you need to look at sort of prior experience. Is that can you observe a relationship between that risk component and how the ultimate purchase price is determined? And so that now we're getting a little bit more judgmental, but I think it would be based on, and the way the example went through was like sort of looking at past experience, pricing conventions, is that sort of thing. So there are, I guess in terms of guidance in the standard, there is some, and as I mentioned, a lot of it is in Appendix B. There are some examples, and so you can kind of read those examples and really infer, what an approach could be or things that you could look at. The standard is, it's got a lot of areas of judgment in application, and not as many bright lines or maybe hard and fast principles. Well, it's principles based, but sort of hard and fast rules. So, and I think in some ways, that's what they were sort of setting out to do, was to try and make it a more judgmental standard. But in some ways, it makes it a little bit harder too, because the exercise of judgment can often be quite tricky, I guess, as we've seen with all sorts of areas of IFRS.
Okay. Well, thank you for that. And maybe one more, Kerry, I think, for you here. It goes as follows. Regarding options and forwards, you talk about being able to differ an amount related to the aligned time value and the aligned forward element in OCI. This concept sounds a bit like the old shortcut or critical terms match concept. Is that correct?
Yeah, I think, Steve, that's a good way to look at it. I remember back to when I was talking about options and forwards, and the aligned time value was the amount, or forward element was the amount that you were able to defer into OCI and keep out of the P&L. And what that was really getting at is how much time value would be in the perfect hedging derivative. So if you didn't have a perfect hedging derivative, how much of your time value would relate to one that is perfect. So in a sense, it almost makes us think again also of the hypothetical derivative type of approach that people have taken. And so it is very similar. It is kind of basically looking at, basically saying you could defer the amount that relates to to a hedge that would perfectly match your exposure. So in that sense, it is kind of like the critical terms match or even a hypothetical derivative approach.
Oh, let's go back to Kiran. Kiran, you still there?
I am.
Good. Okay. Here's the other question. Are there any numeric thresholds to meet the hedge accounting? And I'm assuming the person is making reference to the 80% to 125% ratio we were looking in the past to qualify for hedge accounting.
Yep, no more numeric thresholds. It's not contained within IFRS 9. IAS 39 had a specific requirement embedded right in the standard that said you needed to meet that range, and that's no longer around in IFRS 9. So a bit more flexibility.
So that really goes back to the concept of economic link that you were talking earlier during the session?
Yeah, I mean, that's the most important. You really do need to understand economically the why. Why have you transacted this derivative to manage the risk and this exposure? How do they economically move together? We've had clients going back in time and understanding the economic relationship, especially when the derivative is priced off of a different risk exposure as compared to the hedged item. Mm-hmm. So that's the big basis on which the hedge effectiveness testing qualifying criteria is based on.
Okay. Well, let's maybe one more last question here. It goes as follows. Can my current hedge effectiveness assessment testing be retained?
Good question. Hopefully, if there are clients, some of my clients do regressions for their hedge effectiveness testing. If that relationship is your plain vanilla, for example, managing the interest rate risk, floating rate debt, fixed rate debt, nothing fancy about it, and you're using regressions, there's no reason that regression testing cannot continue into IFRS 9. IFRS 9 does not tell you what type of test to use. It doesn't tell you cannot do a quantitative test. So that's actually something to think about in terms of the level of effort to go through when you do have transactions and trying to support qualitative. It may just be, from a process control perspective, it may just make sense to continue what you are doing for those particular hedge strategies. But it is an opportunity to revisit what you're currently doing to see if you can better streamline, demystify, or simplify the current hedge testing that you're doing.
That's great. So I think that completes our Q&A section here. And I'd like to thank our speakers, Kerry and Kiran. We really hope that you found the webcast helpful and informative. If you want additional information, please visit our website at Deloitte.ca. And to all our all the persons viewing the webcast today, thank you very much for joining us. And this concludes our webcast on the new IFRS 9 hedging model. Thank you very much.